Hello again. In this video, I'm taking a look at portfolio optimization. Now, this is a very complex topic. It's normally used by stock traders, and you start to worry about things like efficiency, tax implications, transaction cost, those types of things. However, most of you are going to be trading Forex and CFD markets, so I'll approach it from that perspective. Longer term trades typically have less in transaction costs because the idea is you enter the trade once, maybe twice, as opposed to again and again and again and paying the spread. Transaction costs really aren't a major issue in the Forex or CFD markets though, because most of the time you're just simply paying the spread. The one thing you need to look at in optimization, though, in these markets is correlation. It's one of the things that will just absolutely kill a portfolio or a group of instruments that you're invested in quickly if you are not cognizant of it. So in front of you, I have the Australian dollar. You can see over time we've risen, we've pulled back significantly, and now we're rising again. Well, a lot of people will perhaps go long of this market, and then they'll look over here in the gold market, and you can see that it's moving in the same direction. The first thing that people will think is, wow, I can make more money by buying both. But think of it this way. What happens if they both turn around? Then you're doubling your losses. Correlation is a very nasty thing if you don't understand it. And it is far beyond the scope of this video to talk about all the different correlations. However, you can optimize your portfolio by investing in non-correlated assets. So for example, maybe buying the dollar CAD and the DAX at the same time. By shorting the Canadian dollar, you're not necessarily risking a whole lot of correlation when it comes to the DAX. The two typically don't trade together one way or the other. It's a situation where maybe one trade pans out, the other one doesn't. But over the longer term, at the very least, you're gaining and losing at the same time. You kind of even things out. In the aforementioned situation with gold and the Australian dollar, yeah, it's great when both move in the right direction, but when they both move in the wrong direction, which they invariably will, the losses can truly pile up. So learning about correlations is probably the most important part of optimization as far as your portfolio is going to be concerned, unless of course you're talking about long-term like retirement planning investments. That brings up an entirely different encyclopedia of information that you have to go through. But there is such a thing when it comes to Forex and CFDs through correlation, through transaction costs. So you do have to be aware of the fact that it's cheaper to trade long term, to hold on to the market, to wonder about swap and if you pay or if you get paid. Although these days you're paying more often than anything else. But you do have to keep in back of your head all the transaction costs, the correlations. That way you can keep yourself from getting doubly hurt if the market goes against you.